Hey everyone, Travis the Stock Geek here, coming at you with another deep dive research video on a company that I think is really interesting and potentially very undervalued. That company is Nordstrom, trading under ticker symbol JWN. Before we get into the presentation, I have to give you the disclaimer. Everything you see in today's video is for informational and educational purposes only. I don't know your specific financial situation, so this is not financial advice. I try to make sure all the facts are accurate in today's video, but it's possible there could be some small inaccuracies. Just remember that at the end of the day, any investments or trades you make are done under your own responsibility. So today I'm going to cover Nordstrom's business model. I'll talk about recent history. I'll touch on trends that have been impacting Nordstrom both pre and post-COVID. Then I'll walk through my investment thesis and why I think the stock is so interesting at today's prices. And I'll go through some valuation scenarios of what I think the business could be worth. I'll also touch on the key risks to my investment thesis, and I'll give you my conclusion on the stock at the end. So let's talk about Nordstrom's business. Nordstrom was traditionally known as a luxury department store retailer, but really over the past decade or two, it has morphed into an omnichannel retailer serving customers across many price points and different channels. So we could probably think of Nordstrom as three different business units: the full-price stores and online, which are the traditional Nordstrom stores and Nordstrom.com. Then we have the off-price business, which is the Nordstrom Rack business. And then there's some other online retail properties like Trunk Club and Hotlook. When we look at how revenue breaks down by category for Nordstrom, you can see that like most department stores, Nordstrom has a pretty big focus on women through women's apparel, shoes, women's accessories, and beauty, but it also has a significant men's apparel business and some kids in other departments as well. Now, Nordstrom is known for a maniacal focus on customers and customer service. So Nordstrom has been known to do style consultations, offer free returns and a very liberal return policy. It does alterations. It has a very big loyalty program. And it really does try to make sure that the customers walk out of the store happy, have a great experience, and come back. Nordstrom also really focuses on curating an assortment of high-quality brands that are in demand. So when you think about these curated assortments of marquee brands, it includes the designer brands like Balenciaga and Gucci and Golden Goose. It includes mass market brands as well, like Nike and Topshop and Ted Baker. And Nordstrom also sells emerging brands that are becoming hot, things like Allbirds or Bonobos or Greats. And of course, Nordstrom has its own brands as well, which it sells, including Zella, its new athleisure brand, brands like Treasure and Bond. Nordstrom's full-price business accounts for about 2/3 of the company's total revenue, which was around $10 billion of annual sales in 2019. This includes the 116 full-price brick-and-mortar stores as well as Nordstrom.com. Now, the brick-and-mortar stores are in very high-quality urban, high-foot traffic locations. In fact, 70% of Nordstrom full-price stores are in the top 20 US and Canadian cities. Online accounts for about 40% of the full-price business, so very nice online penetration in the full-price business. When you walk into a Nordstrom full-price store, you'll find that it's very nicely merchandised, well-lit, uncluttered, and these are pretty large format stores, about 150,000 square feet on average. You can see some pictures I took of a Nordstrom full-price store, and you can tell they're very nicely apportioned. They don't look like some of the other department stores, which just cram in a ton of merchandise racks everywhere. Nordstrom turns its inventory in the full-price stores about 5 times a year, so it really does try to keep the inventory fresh. The off-price business for Nordstrom accounts for about 1/3 of the company's total revenue, and this is the Nordstrom Rack business, both the brick-and-mortar stores, of which there are about 242, and NordstromRack.com. Now, the online portion of Nordstrom Rack was about 20% of total, so a little bit lower penetration than the full price, but definitely growing quickly. The Nordstrom Rack stores are not located in high-quality Class A malls like the full-price stores, but they're actually located in strip and power centers, still in those very high-quality urban markets. In fact, about 3/4 of Nordstrom Rack stores are in the top 20 urban markets. Around 1/3 of Nordstrom Rack customers end up becoming full-price customers, according to management, so there's some nice synergy there. And then in terms of financial impact, the off-price business has lower merchandise and gross margins than the full-price business, but according to management, it does have a similar operating profit because there's less occupancy and overhead like commissioned salespeople in the off-price business. When you walk into a Nordstrom Rack store, you'll find that it doesn't look as luxury as a Nordstrom full-price store, but it is certainly well merchandised, especially when comparing to some of the other retailers that are bargain retailers like TJ Maxx or Ross stores. It is definitely a paradise for bargain hunters. Now we can break down the business mix of Nordstrom a little bit more granularly, and here I've done that. You can see the full price online, full price stores. We've got off-price stores and off-price online and what they make up in terms of total revenue. So overall, online revenue is around $5 billion, or it was prior to COVID. Now, Nordstrom has been very disciplined about its store count over time, especially with the full-price stores. You can see here, Nordstrom has not grown the full-price store count very much over the past decade or so. It did expand the Nordstrom Rack business as it was seeing success over the past decade or so, but still, the store count is relatively small compared to other discount retailers. And when you look at the full-price store count, if you look at a other department store like Macy's, which has over 500 stores, or JCPenney, which had over 800 stores prior to bankruptcy, you can see that Nordstrom definitely has been disciplined about its overall store count. It doesn't appear that Nordstrom has too many stores necessarily. Now, when you look at the geographic markets, like I said, Nordstrom shows up in pretty much all the top US and Canadian cities that you'd expect, like LA, New York, Chicago, Dallas, Phoenix, Toronto, Vancouver, Boston, Philadelphia, etc. So there is significant concentration of Nordstrom stores on the West and the East Coast, and this is important. This actually does have some financial implications, especially in a year like 2020. California stores themselves made up about a quarter of the total Nordstrom stores. Los Angeles is the number one market for Nordstrom, and New York City is the number one online market. Nordstrom was founded over 100 years ago by John W. Nordstrom, and his initials are actually where the stock ticker JWN comes from. Today, his great-grandsons are still helping lead the company from the executive suite, and the Nordstrom family maintains a 31% ownership stake in the company. Eric and Peter Nordstrom are co-presidents. Eric is the CEO. Peter is the chief brand officer. James Nordstrom leads the full-price stores division. Now, sadly, Blake Nordstrom passed in early 2019. He was the former CEO and a very well-respected leader both inside and outside the company. The Nordstrom family is backed up by a very experienced management team, many of which have been with the Nordstrom company for many years. The Nordstrom board is also a very diverse and experienced board of directors, so it's great to have a very deep bench helping lead the company. Now, Nordstrom is a very shareholder-focused company. It has very good corporate governance and is really focused on driving shareholder returns. As you can see, the company really focuses on making sure the business is healthy, and then beyond that, it tries to maintain a focus on dividend payouts and share repurchases and just overall strong capital allocation. They use metrics like return on invested capital with goals that they have for those metrics that they want to hit. So that's all great signs as a shareholder. Let's talk Nordstrom business trends prior to the COVID crisis. Now, it's no secret that department store sales in North America have been declining in the past decade. This chart from the Federal Reserve shows that department store sales are down by about 1/3 in aggregate since 2010. Nordstrom, however, has been much more resilient. Nordstrom's revenues have actually grown by about 50% since 2010. And Nordstrom has gained market share in the department store sale industry, and department store sales still represent several $100 billion of annual revenue. One of the things that has helped Nordstrom grow over the past decade and take market share is their focus on online channels. Nordstrom Online has grown from about $800 million of sales in 2009 to over $5 billion of annual sales in 2019. That represents about a 20% compounded annual growth rate over the past decade. Nordstrom's growth has not come without significant cost or effort, however. Nordstrom has been investing heavily over the past few years in what it calls its generational investments. That includes investing significantly in distribution and fulfillment infrastructure for its online business. It includes expanding into Canada, which began in 2014. It, of course, includes expanding the Nordstrom Rack store base. And Nordstrom has been opening new local concept stores, which are stores that do not carry much inventory, but offer services and the ability for customers to return and pick up merchandise. Nordstrom also invested heavily in New York City by opening up a new flagship store there in late 2019. And Nordstrom invested in acquiring Trunk Club, a subscription clothing service. Now, these generational investments, according to management, have large potential payoffs. Management believes, for instance, that Canada can be a $1 billion revenue opportunity for the company. It also believes that New York City, which is its second largest market and its largest online market, can grow to add several $100 million more of revenue over time. It believes that Trunk Club can be a $500 million plus revenue opportunity. And when you look at Trunk Club's closest competitor, Stitch Fix, it's over $2 billion of annual revenue already. Now, the local stores can be up to a 1% sales lift in local markets, according to Nordstrom, which doesn't sound like a lot, but in some of Nordstrom's top markets, that could mean tens of millions of additional sales and also reduced inventory markdowns because Nordstrom can turn its inventory faster. Now, the supply chain investments obviously enable a more unified and seamless experience across both stores and online. So you can see in this map some of those investments like local stores in top markets, as well as the new omnichannel fulfillment centers. Nordstrom's generational investments have weighed down profits over the past decade. Here you can see the impact on operating profits over the past 8 years or so from some of these generational investments. In certain years, it's been more than a $100 million headwind to profits. Another way to visualize this is to look at operating profit margins, or earnings before interest and taxes margins, from the income statement. Nordstrom was producing close to 10% EBIT margins, that is, earnings before interest and taxes as a percentage of revenues, at the beginning of the decade, but that number has come down to only about 5% of revenues in 2019. CapEx, or the cash outlays that Nordstrom has had to spend on their generational investments, has been elevated as well. You can see in 3 out of the last 5 years, Nordstrom spent more than $800 million of CapEx, or more than 5% of revenue. The New York flagship store alone, I estimate to be around a $500 million investment. Now, the good news is that management has stated that their goal is for CapEx to moderate in the future to around 3 to 4% of revenue going forward. So the cash flow impacts were temporary, hopefully. You can see here the Nordstrom cash flow metrics from 2015 to 2019. I show the cash flow from operations number for each year, as well as the capital expenditures, or CapEx, and then the resulting free cash flow, which here is just represented by cash flow from operations minus CapEx. And this typically is meant to represent the amount of cash flow that is produced for the year that can be paid out to shareholders, either via dividends or share repurchases. So you can see here that free cash flow has declined every year over the past 5 years. Now, 2015, it is worth noting the cash flow from operations number did include a one-time sale of Nordstrom's credit card receivables, so this number is a little bit elevated relative to what it would normally be. But you can see here the impact on cash flow of the generational investments has been significant. So prior to the COVID crisis, Nordstrom management believed that over the next several years, the business would see an increase or an inflection in sales, operating profits, and free cash flow. In fact, management was forecasting that the business might produce north of $1 billion of free cash flow for shareholders by 2022. This is because those generational investment costs would be behind them and those generational investments would start to pay off. You can see here management expected operating profit margins to push closer towards 7% by 2022 based on leveraging digital as well as local market strategy, scaling the generational investments, and being disciplined on the cost side. Now, management believed that the markets were undervaluing Nordstrom prior to COVID. The Nordstrom family seemed to believe that the market wasn't appreciating the fact that the business could see a significant increase after their investments finally began to pay off. So Nordstrom Family actually tried to buy out the company at around $50 a share in 2018. Nordstrom's board, however, decided that the price for the company was a little bit too low and the buyout did not proceed. In 2019, the Nordstrom family actually looked at increasing their ownership stake in the company. If you recall, the Nordstrom family has about a 31% ownership stake in the company, and it was rumored that they might be looking to increase their stake to perhaps as much as 50%. At the time, Nordstrom stock was trading in the high 20s and low 30s, and ultimately the Nordstrom family did not end up increasing their stake, but it's clear that they felt the market was being too short-sighted about the value of the company. Just prior to the COVID crisis, Nordstrom management put out their guidance for what they thought the business could produce in 2020. That included slight revenue growth, as well as slight improvements in operating profit margins, and lower CapEx for the year. I actually plugged some of these into the projected income statement and cash flow statement for Nordstrom, and you can see that implied roughly a $3.46 net income per share for 2020 and a $3.50 free cash flow per share estimate for 2020. This lines up pretty well with management guidance for EPS of $3.25 to $3.50 for the year in the Q4 2019 earnings presentation here. Now, Nordstrom stock at the time was trading around $41 per share, or roughly a 12 times expected 2020 free cash flow multiple. That's a pretty low multiple, a below market multiple, since most companies trade above 15 or 20 times expected free cash flow. Now, those low multiples would typically be associated with companies with lots of debt or limited growth prospects, so one could make the case that Nordstrom stock looked relatively inexpensive just prior to COVID. We now know that the coronavirus crisis became a significant global event affecting societies and businesses worldwide. The coronavirus crisis has been especially painful for businesses like Nordstrom's, which depend on physical stores. So to recap what has happened at Nordstrom's in 2020, in early March, Nordstrom was forced to temporarily close all of its physical stores. On March 23rd, management took quick action by suspending dividends and share buybacks, and the company drew down $800 million on their revolving credit line. They also targeted $500 million of additional cost cuts this year. These actions were all done to make sure that the company had the liquidity and ability to survive the crisis. Additionally, on April 8th, the company raised $600 million of new debt at 8.75% annual interest rates, which was a much higher rate of interest than Nordstrom was paying on its debt prior to the crisis. But this new capital would help strengthen the balance sheet for the year. On May 5th, management announced that Nordstrom would be closing 16 of its 116 full-price stores. Now, this was done to really make sure that the company had a right-sized store base that would be profitable and cash flow generative going forward. Management said that these stores were mostly older stores that were in markets which could be served by other Nordstrom stores. On May 28th, Nordstrom reported their Q1 results. Q1 for Nordstrom encompasses February, March, and April months, and revenue was down 40%, with the stores being closed for about half the quarter. In late June, luckily most of Nordstrom's stores began to reopen or were reopened in some capacity. The anniversary sale of Nordstrom's is a significant sale that produces a significant amount of annual revenue, and that would typically occur in July, but Nordstrom actually postponed that into August to make sure that it could fulfill demand and have all of its stores be open for that sale. On August 25th, Nordstrom reported its Q2 results, which encompasses the months of May, June, and July, and Q2 results showed revenue down about 53%. Now, it was interesting to see that Nordstrom did actually generate positive cash flow in the second quarter despite the really significant revenue headwinds. So let's look a little closer at the first half of 2020's financial metrics for Nordstrom. Nordstrom's revenue was down 46% in the first half of 2020 from the first half of 2019. I do estimate about 10% of this decline was the impact from the shift of the anniversary sale into Q3 2020, which would normally be in Q2. Now, gross profits were down even more because Nordstrom took action to cut prices on merchandise early in the coronavirus to make sure that it could clear out excess inventory. So gross profit was down around 71% year over year in the first half of 2020. Cash flow from operations showed a large cash burn in Q1 and a slight cash flow positive in Q2, but overall cash flow from operations was negative $591 million in the first half of 2020, which is down significantly from almost $700 million in cash flow from operations generated in the first half of 2019. So you can see that the coronavirus crisis had an immense impact on Nordstrom in the first half of 2020. Like I said, management has acted quickly to reduce costs, and management has already realized over $400 million of cost cuts in the business since the coronavirus crisis started. This will help ensure the business survives. It will also help the business, hopefully, eventually become profitable again as the consumers begin to return and the sales recover. So you can see here that management targeted originally about a $500 million cash savings across CapEx, operating expenses, and working capital. And you can see that they have mostly realized those savings already just through the first 2 quarters of the year. Because of the cash burn in Q1, when Nordstrom stores were largely closed, the company felt it was prudent to raise more debt capital to ensure it would have the liquidity to survive a prolonged crisis. So prior to the crisis, Nordstrom had around $1.8 billion of net debt. I define net debt here as total gross debt on the balance sheet minus cash on the balance sheet. I do not capitalize leases because the cost of those leases already runs through Nordstrom's income statement. So net debt prior to the crisis, about $1.8 billion, or around 1.2 times 2019 EBITDA. That's a pretty low level of leverage overall. Annual interest expense was about $120 to $125 million, very well covered by the amount of profits that Nordstrom was generating. Now, after Nordstrom raised its new debt, the total net debt was about $2.8 billion as of the second quarter. Gross debt is around $3.8 billion, and that includes the new senior notes that were added as well as the revolver draw. So net debt is now around $2.8 billion, and that's around 1.8 times 2019 levels of EBITDA, which is not a crazy level of leverage, assuming the business can recover. Interest expense is going to be higher going forward at close to $200 million a year. Now, the debt increase, as well as worries about retail and recovery, led to a massive decline in Nordstrom's share price. Nordstrom stock was down 70% in the month of March 2020, and it really has not yet recovered. The stock is still near its March lows, despite the fact that the equity markets and many other stocks have recovered nicely. One of the impacts of the shutdowns and the coronavirus crisis has been a significant shift to e-commerce spending among consumers. E-commerce was already gaining share of overall consumer spending prior to the crisis, but the crisis really did accelerate spending, and the accelerated multiple percentage point gain of share by online. You can see that in the charts here, as online was gaining about 1% of spending a year, and in the COVID crisis gained almost 5% of overall consumer spending. And that makes sense. If consumers can't go into stores, they're going to turn to online alternatives. But luckily for retailers, physical retail traffic is slowly starting to recover now that many centers are back open. So here you can see S&P Global Markets estimates of foot traffic at malls and outlet centers, and they show that there has been a recovery, slow recovery of foot traffic since March and April, when everything was pretty much down 100%. So there are areas like New York and California that have been slower to recover because of extended lockdowns in those areas. But most stores and malls are now open, even in those states that were slow to reopen. That has led to a recovery in many retail stocks. Here you can see the chart of Nordstrom stock performance versus other publicly traded retailers such as Gap, Dillard's, Abercrombie, Urban Outfitters, Dick's Sporting Goods, L Brands, etc. Here you can see that some of these stocks are actually up year to date, and even Dillard's has recovered far more than Nordstrom stock has recovered. Nordstrom really is the outlier here on the stock price performance chart. It is interesting to see that they're still very close to their March lows, with most other retailers up significantly from those March prices. The other thing that I notice about Nordstrom stock is that it has a large number of short sellers betting against the stock. The short interest has increased massively in Nordstrom stock over the past several months. In fact, the short interest as a percentage of the outstanding shares is now over 30%, which is a very, very high level of shorts. Shorts, by the way, are those who are betting against the price of a stock, so short sellers benefit if Nordstrom stock goes down in price. I think Nordstrom stock at current prices represents a compelling investment opportunity. Let's talk about why. If Nordstrom's business fully recovers, the implied valuation today with the current stock price is crazy cheap. The current market cap, as I'm producing this video, is around $2.1 billion for Nordstrom. Now, pre-COVID estimates of free cash flow for the Nordstrom business are between $500 and $600 million. That means that the implied free cash flow multiple with today's stock price, assuming the business were to fully recover, is less than 4 times. Now, 4 times free cash flow would be a crazy low multiple, only reserved for businesses that are in distress or will be completely gone in a couple of years. Clearly, investors in the market currently do not believe that Nordstrom's business will ever fully recover, or even recover to levels close to what it used to produce in terms of earnings or free cash flow. We can see this another way by looking at the historical earnings or cash flow multiples that Nordstrom stock has traded at in the past. Historically, you can see that Nordstrom's one-year forward price-to-earnings multiple has been in the low to mid-teens range. So 3.9 times today would be crazy low compared to the past. Nordstrom typically trades at 12 to 15 times forward earnings. And if Nordstrom could produce $3 of earnings per share again and garner a 12 times multiple, the stock would be a triple. So obviously the old numbers may not be as relevant as they once were. But we can determine what the potential value and upside of the stock might be if we can quantify what the permanent business impacts will be, come up with new financial estimates for earnings or free cash flow, and then apply an appropriate valuation multiple like price to earnings or price to free cash flow. Luckily for us, Nordstrom is a relatively simple and profitable business in normal times, so we can utilize these simple multiple approaches. We can also use an approach called sum of the parts, which might give us an idea, too, of what the business could be valued at if it were split into its various parts. We'll walk through that as well. Lastly, we can evaluate scenarios and figure out, even in different types of economic environments, if the stock still provides upside. So what will the new normal for Nordstrom's business look like? There are a number of headwinds. The economic recovery is uneven. There are areas of the economy that are doing well and growing again, but there are pockets of the economy that are still struggling. Unemployment rates are still relatively elevated. Without more stimulus, there's talk that the economy could go into a second wave of weakness. We also have second waves of shutdowns in areas where virus cases are spiking potentially. And then there's evidence that urban residents have fled certain cities for suburban or rural environments. And then we might have permanent loss of foot traffic to malls with certain retailers going bankrupt. And there's also potentially a permanent loss of market share from brick and mortar retailers to online retailers. But in terms of opportunities, we do see in the data that foot traffic to shopping centers is recovering. And businesses like Nordstrom that have significant online components have continued to grow. Online has been a really nice bright spot, even for Nordstrom. And then market share could be gained from the bankrupt retailers like JCPenney or Lord & Taylor, which are shuttering lots of stores. And Nordstrom has those generational investments that could also bear fruit in the future. The New York City flagship store, for instance, was only open a couple of months before it had to get shut down due to the virus. We have not yet seen what a full year of an open flagship might look like. There's also the Canadian stores and the local store impacts. So again, the generational investments may not have had an opportunity to shine yet. And then Nordstrom's off-price business, Nordstrom Rack, should be able to flourish in a tough economic environment. Discount retailers tend to perform well when the consumer really cares about how much money they're saving and spending. Many of these impacts are hard to quantify right now. But what do we know today? Well, we know that Nordstrom is permanently closing 16 of its full-price stores, and that's going to have a financial impact. We also know that Nordstrom management has targeted a 20% reduction in overhead expenses. In fact, through the first 2 quarters of this year, we've seen them cut SG&A expenses by 16% year to date. We know that Q2 will likely be the worst quarter of 2020 for Nordstrom, assuming there aren't any significant society-wide shutdowns of shopping centers. And we know that if stores are not closed in 2021, there will be some level of sales recovery for Nordstrom. I mean, the baseline is 0 for stores in March and April, so we know that there should be some sales recovery from that level, assuming we have vaccines or better management of the virus and just a desire to not shut things down the way that we did last spring. We know also that Nordstrom's online business appears healthy. Management indicated that the online business is actually growing this year in its most recent financial report. And we know that the off-price business, Nordstrom Rack, has been recovering slightly faster than the full-price business so far this year. So we can use a lot of these knowns to help us model what the recovery might look like for Nordstrom. Rather than try to forecast what the business is going to look like, say, 10 years from now, I think it's helpful to figure out what might 2021 numbers look like. And I start with a 2020 estimated revenue bridge. This is really a way to look at the different components of the Nordstrom business, figure out how those are impacting the business this year, and what those impacts might look like next year. So we start with the $15.5 billion of revenue that Nordstrom produced in 2019. Next, I estimate the loss of revenue from the full-price stores, which Nordstrom is closing, those 16 full-price stores, which will never reopen. And I estimate those stores were doing about $1 billion of annual revenue in total. So that is $1 billion of revenue reduction for 2020 right off the bat. Next, I look at the full price stores that will remain open going forward, but were closed in the spring, and I look at what is going to be the revenue decline for those stores this year. Now, we can actually look at the financials of Nordstrom through the first 6 months of this year, and that shows us how much has already been lost through the first 6 months, and we can estimate what the recovery will be like in the second half of the year, and what that means overall for the total amount of revenue we think will be lost by full price stores in 2020. So without going too far into the weeds, I estimate this at around $2.5 billion for 2020. Then we can do the same thing for the off-price stores and figure out what we think the total sales decline will be for the off-price stores in 2020. And this bakes in the revenue that's already been lost through the first half of the year, as well as how much revenue we think will be reduced from the back half of this year compared to 2019. Lastly, we look at the online business, which we know is growing between 10 and 20% according to management comments from the Q2 earnings call, and I estimate that will actually contribute a positive impact of around $500 million or $500 million this year. And that gets us to what I think the 2020 revenue will be by the end of the year for Nordstrom, and I estimate that somewhere in the neighborhood of $11 billion. Might be a little less or a little more, but that's my current estimate. It is worth noting that I am making the implicit assumption there won't be some nationwide mandatory shutdown of brick and mortar shopping centers in Q4. But I do think this $11 billion number is a good number to work off for now. And we can look at our 2020 potential estimates by starting with 2020 and then estimating the impacts from the various business components. So if you recall, the full price stores lost about $2.5 billion of sales in 2020 as a result of being closed for half of Q1 and Q2. Now, I think that the full price stores can recover 60% of their lost sales from 2020. I do actually think they could recover more, but I'm going to use a conservative estimate here. So I assume that the full price stores will recover $1.5 billion of the $2.5 billion lost last year just by virtue of being open for more days and more months. Same deal with the off-price stores. I believe that they can actually recover around 80% of their lost sales from 2020 by virtue of being open and attracting the bargain shoppers again. In terms of the online sales increase, I expect that online sales could continue to increase for Nordstrom as they have over the last decade, and that could contribute another $500 million of sales increase next year. But there will be an impact from the permanently closed full-price stores, which contributed revenue in January and February of 2020, but will not contribute revenue in January and February of 2021, so that is a negative impact. Overall, I end up with an estimate for 2021 Nordstrom revenue around $13.7 billion, and I feel this is a pretty conservative figure given the trajectory of overall retail sales. We have seen data that suggests the U.S. retail recovery for brick and mortar retailers is continuing. This is recent data from the Census Bureau, which includes data through September 2020, and this charts the change in year-over-year retail sales in both the department store category and the clothing store category. Here you can see these categories were down as much as 80 to 90% during the shutdowns in the spring, but have recovered consistently. We're down about 20 to 25% through the summer months, and in September actually improved to being down only about 8 to 12% overall. So as I think about what 2021 might look like for Nordstrom in terms of revenue, income, cash flows, I can build out my estimates for what I think the company can produce. I showed the $13.7 billion revenue estimate on the previous slide, and I felt that was relatively conservative. But I'll start with a slightly more conservative number on the income statement of $13.5 billion of revenue for 2021. Now, I can also estimate the gross margin levels, the SG&A that Nordstrom will have after the cost cuts that they anticipate, and that will spit out what I think the earnings before interest and taxes will be. And I estimate the increased interest expense and taxes for next year, and that will give me a net income figure. And if I divide that by the outstanding shares, I'll get my estimated earnings per share figures. I can also do my estimates on the cash flow side by taking that earnings before interest and taxes number, adding back the estimated amount of depreciation and amortization, subtracting interest expense, subtracting taxes. I assume net flat number for working capital. This number could be positive or negative. I won't try to estimate that here, but that gets me to an estimated cash flow from operations number. And if I subtract the amount of CapEx expected next year, that will get me to my free cash flow number and a free cash flow per share number. Again, remember that CapEx for Nordstrom should be coming down from prior years, especially in this type of environment. So I assume that Nordstrom will be spending between $500 and $600 million of CapEx next year. That would be actually still a very healthy level of CapEx, but below the higher levels of spending that we saw when they were making their generational investments in prior years. So you can see these numbers here suggest around $2 of earnings per share on the income statement side and around $3 of free cash flow per share. Now, why is there such a big difference between income and cash flow here? Well, the real difference is because of the CapEx. The cost of the prior CapEx spending is still flowing through the income statement, but the significantly lower CapEx on the cash flow statement means that there's a pretty sizable difference between actual cash flow and reported GAAP earnings. So I like using free cash flow per share. This is the actual cash flow I think the business will generate that will be available to either pay down debt or pay shareholders. So this is a pretty interesting number. This suggests that Nordstrom, under relatively conservative estimates, could be producing north of $3 of cash flow per share next year. With Nordstrom's stock price hovering around $13 today, you can see that based on my estimates of $3 of cash flow per share, the stock is only trading at just over 4 times 2021 free cash flow. That is an exceptionally low multiple. Now, again, I could be wrong about my estimates here. Perhaps gross margins won't be this healthy if Nordstrom has to resort to massive discounting next year, or if somehow stores end up shut down again. But I think these are pretty reasonable and conservative numbers to work off of for 2021 for the time being. I can also compare the current Wall Street analyst estimates with the numbers that I'm coming up with. I call this a sanity check to make sure I'm not just wildly off the mark. So if we look at, say, revenue estimates for the next couple of years, the consensus estimates among around 20 Wall Street analysts suggest that they expect 2020 revenue to come in around $11.2 billion. I was at $11 billion, so I'm actually slightly lower than consensus. But for 2021, these analysts expect revenue around $13.6 billion, $13.7 billion, and that is right around where I was estimating. And of course, I used the $13.5 billion revenue figure in my previous numbers to be even more conservative. So I'm pretty close there on the revenue side. On the earnings per share side, it looks like the consensus analyst estimates are around $1.50 or $1.40, $1.50 of earnings per share in 2021. And that is lower than my $2 earnings per share estimate. And of course, significantly lower than my free cash flow estimate. But I think free cash flow is the more important metric to be focused on. Now, if we look at a sensitivity table, we can see what the stock price might be if it actually did get its historical free cash flow multiples. So here I have a table where I've got different free cash flow multiples on the left, and then I have my estimated free cash flow per share up here. So using different figures, if I am off the mark with my $3 figure, we can still see what the stock price might trade to based on different multiples and different levels of free cash flow per share. Here you can see if the stock were to trade up to a more historical multiple of, say, 12 times free cash flow, and they did produce $3 of free cash flow per share in 2021, the stock could trade up to $36 a share. That'd be almost 3 times today's stock price. Now, if they produce less free cash flow per share, let's say $1.50 or $2, and it gets a lower multiple, you can see the stock may not be as undervalued if that's what you assume. But again, I am much more confident that the numbers will be more like these columns, and that suggests pretty significant upside to the current stock price. One other method besides the price to free cash flow or price to earnings multiple method we could use to value the business is the sum of the parts method. In a sum of the parts valuation, you take a business like Nordstrom that has multiple business units, and you value each business unit separately, and then add up the values at the end, subtract the debt to get to the value for shareholders, divide by the number of shares to get an implied price per share. So with Nordstrom, the business units might be the full-price brick-and-mortar stores, the off-price Nordstrom Rack brick-and-mortar stores, the full-price online business, and the off-price online business, which we could actually combine into one business unit that we call the online business. And then there's other stuff that Nordstrom owns, like real estate, that might also have some value. So looking first at the full price stores, what those might be valued at separately. Well, we know that the Nordstrom full price stores produced around $6 billion of revenue in 2019. That's based on the numbers that are reported in the financials that show around $10 billion of full price total revenue, but we know 40% of that is online, so 60% is brick and mortar stores, so that gets us that $6 billion of revenue figure. But we know that 2020 had a major impact on the brick and mortar stores. Not only is Nordstrom closing 16 stores permanently, but it also has its existing stores still taking a hit from the shutdowns and just the overall economic environment. So we need to estimate what we think the go-forward revenue into 2021 and 2022 could be for the full-price stores. And I have some different estimates here in this table from $3.5 billion up to $6 billion. And I think it probably will fall somewhere in that $4 to $4.5 billion range. That assumes a loss of about 10% of the store revenue from the permanently closed stores, and the stores, full-price stores, recovering about 60 to 70% of their lost revenue in 2021. So if you assume $4 to $4.5 billion of annual revenue brick and mortar stores will produce, and you apply a reasonable revenue multiple, you'll see what you think the estimated value of the brick and mortar stores business could be. Now, I apply what I think are pretty reasonable multiples on these 2021 estimates for the full price stores, and I get to a value somewhere in the $1.5 to $2 billion range. So let's talk about the multiples that I'm using, the revenue multiples here. The reason I use revenue multiples, by the way, is that Nordstrom doesn't necessarily tell us how much profit each business unit produces. We do have a split of revenue in the financials, and they have made comments in the past that the full-price stores and the off-price stores have similar operating margins. They've also said that the online business has similar margins, so we don't have to do too much extra work on the profit side, but we'll use a revenue multiple just to make it more simple here. So looking at revenue multiples of competitors and also revenue multiples that the Nordstrom business as a whole has traded at in the past, you can see the different levels over the last few years. Now, Nordstrom typically has traded at a premium to other U.S. department stores, and it's typically traded above the 0.5 times market cap to last 12 months revenue level. So again, if you look back at the multiples I was using the range of 0.2 to 0.7, with the middle of that range probably being somewhere around 0.4 to 0.5 times for the brick and mortar stores. So I think that's a reasonable multiple to use that's relatively in line with history and actually below the level that Nordstrom has traded at often in the past for the overall business. Let's look at the Nordstrom Rack, or the off-price brick and mortar store business, and value that part of Nordstrom. So Nordstrom Rack is a discount retailer that competes against peers like TJ Maxx and Ross stores. It has grown a lot over the past 10 or 15 years. You can see it was only about $1 billion of revenue back in 2007 and was pushing over $5 billion of revenue recently. So Nordstrom Rack has seen a little bit of slowdown in growth in recent years. It was up 4% in 2018, but flat in 2019. I'll note that TJ Maxx and Ross stores have a much, much larger store base. TJ Maxx at about 10 times the US stores, Ross at about 7 times the Nordstrom Rack store base. And those companies are actually growing a little bit faster recently than Nordstrom Rack. But I do think Nordstrom Rack overall is a pretty quality business that should be able to grow longer term, especially when you look at the revenue that TJ Maxx and Ross stores produce. Those are much, much larger than what Nordstrom Rack does today. So there could be quite a long runway of growth for Nordstrom Rack. Now, Nordstrom Rack does actually have a little bit more of an affluent customer. It stores our merchandise a little bit differently. But looking at these discount retailers, TJ Maxx and Ross stores, they have had really nice share price performance over time, and the market has given them pretty decent multiples on their stock. So you can see historically, TJ Maxx and Ross stores have traded right around 2 times or just sub 2 times market cap to last 12 months revenue, and they have actually expanded their valuation multiples over time. When we look at EBITDA multiples, the average enterprise value to last 12 months EBITDA multiples are somewhere in the 12 to 20 times range for TJ Maxx and Ross stores. So we can use those comparable multiples to actually value the Nordstrom Rack off-price brick and mortar business. I'll do it both ways. I'll do the revenue and the EBITDA valuation. And really either way, you'll get to a similar level depending on the revenue multiple and EBITDA multiple you use and the revenue and EBITDA that you estimate Nordstrom Rack can produce. Now, I think Nordstrom Rack can pretty quickly recover its lost sales in 2020. So by 2021, 2022, I think it could be back producing close to the $4 billion of revenue that the brick-and-mortar Nordstrom Rack business was producing pre-COVID. And even if you use a $3 or $3.5 billion annual revenue number for Nordstrom Rack and assume a multiple that's well below TJ Maxx and Ross stores at, say, 1x, you're still getting a $3 to $4 billion value for the Nordstrom Rack business. Same thing with the EBITDA. I just apply Nordstrom's overall EBITDA margin to the Rack business and then apply a multiple that's below TJ Maxx and Ross stores multiples, and I'm still getting well north of $3 billion potential value for Nordstrom Rack brick and mortar. That brings us to Nordstrom's online business. And here I'm combining NordstromRack.com, Nordstrom.com, TrunkClub.com, and Outlook.com. So Nordstrom's online businesses accounted for around $5 billion of total revenue in 2019. And online has been growing consistently about 10 to 20% a year for Nordstrom. In fact, according to management comments on the most recent conference calls, I believe the online business is actually still growing in 2020. And online businesses aren't always profitable, but Nordstrom's, thankfully, is actually profitable. Nordstrom called out in its investor presentation in 2018 that their online business margins are actually similar to the brick and mortar store margins. The online business has higher distribution and shipping costs, but lower selling and labor costs because it doesn't have commissioned salespeople, and it has a different occupancy structure as well. So when it comes down to it, according to management at least, the Nordstrom business, online business, has the same level of contribution margin on a given order as the brick and mortar stores. So that's great to see. And Nordstrom's online business is actually considered an industry leader in many ways in the retail business. This is a survey of NPS scores by different industries, and you can see here Nordstrom's actually listed in the online shopping category as a leader with a very high Net Promoter Score. Net Promoter Scores are a gauge of consumer satisfaction or consumers' willingness to recommend a brand to their friends. So it's great to see that Nordstrom is actually considered by many to be a leader in online retail. Now, you wouldn't know it by valuations. When you look at other online apparel retailers that trade publicly, companies like Stitch Fix, Revolve, RealReal, or Farfetch, they trade at really high market cap to last 12-month revenue multiples. In fact, most of them trade somewhere in the 2 to 4 times market cap to last 12-month revenues. And occasionally they trade much higher, like Farfetch here. So if we try to value Nordstrom's online business, we don't have to make too many assumptions because we know the business is pretty stable and perhaps continuing to grow. So you can take the $5 billion revenue estimate or even a slightly higher figure and apply a reasonable revenue multiple to it to get a value of what we think the online business alone could be worth. Again, I'll use a revenue multiple that's well below some of its publicly traded peers. If you use just a 1 to 1.5 times revenue multiple on this great online business, you'll get a value for the online business somewhere between $5 and $10 billion. So that's higher than the entire market cap and higher than the entire enterprise value of Nordstrom currently at the current stock price. Lastly, that brings us to valuing the other stuff that Nordstrom owns, which isn't necessarily a business unit, but might still provide some value for shareholders. Turns out that Nordstrom owns underlying land and the building structures at 33 of its full-price stores, and it owns the building structure at another 60 of its full-price stores. So their full-price stores, if you remember, are very desirable urban locations in top cities in North America. They have high population densities. They're real estate that would really have a ton of value. And in fact, on Nordstrom's balance sheet, the value of the land and the buildings is around $1.8 billion, and that probably understates the true market value of the land and the buildings. The New York City flagship alone cost Nordstrom over $500 million by my estimate, so there's significant value in just that one asset. The New York City flagship is just south of Central Park in a really desirable location in Manhattan, for instance. Now, a lot of these real estate assets would be difficult to monetize without affecting the core business. They couldn't operate their brick and mortar stores if they were selling the land and the buildings, unless they did some type of sale leaseback transaction to unlock some of the liquidity, but they're probably unlikely to do that. So that is a headwind to valuing some of the real estate here, but I will say that they did close 16 full-price stores permanently, and there could be some value coming from that land and buildings. So to sum it all up in the sum of the parts valuation, we can add up the values of these different business units we've just valued. We could do a low-end value and we could do a high-end value. So for instance, for the full-price stores, I could assume $1.5 billion for the full-price stores on the low end and the $2 billion on the high end. For the online business, you could assume $5 billion on the low end, maybe $8 billion on the high end. This is even a little bit conservative. Like I showed earlier, the online business could have value of $10 billion or more under certain circumstances using certain multiples. But overall, the value that I get is shown here, and then we subtract the net debt. That's about $2.8 billion currently, and that gives us an estimated equity value here of about $6.7 billion on the low end and about $11.7 billion on the high end using the sum of the parts valuation method. If we divide by the diluted shares outstanding, that gives us an estimated share value of around $42 on the low end and around $75 on the high end. That's 3 to 5x the current stock price. So the sum of the parts valuation, like our other valuation methods, implies significant upside from the current stock price. At these undervalued share prices, is it crazy to think that acquirers might be interested in trying to acquire Nordstrom? I don't think it's crazy. And in fact, I think that there are companies like Amazon that could be interesting potential acquirers for Nordstrom. I'm not sure that the Nordstrom family wants to sell down here or even sell at a 50% premium to current prices, but it's interesting to think about why Amazon in particular might be interested in acquiring Nordstrom. Amazon has struggled in the past to break into the more high-end parts of the apparel market, particularly with luxury brands. Amazon could actually leverage Nordstrom's brand and fashion relationships and become a player in that end of the market. And Nordstrom could benefit from Amazon's technology and technological expertise. They could utilize Amazon Web Services, Amazon's robot and warehouse automation technologies. They could leverage Amazon's extensive machine learning and AI software for personalization, for things like augmented reality in the future. And Amazon could actually leverage Nordstrom's store footprint to give Amazon more physical store distribution. Amazon has been expanding into more physical stores in the past few years. And remember, Amazon acquired the high-end grocer Whole Foods in 2017. They've also acquired other retailers like Zappos in 2009. And both companies, Nordstrom and Amazon, are actually headquartered in Seattle, Washington. So there potentially could be some nice cultural fit and easier integrations just due to the fact that they're headquartered in the same region. Maybe it's a crazy thought, but I don't think it's that crazy. One thing that I am certain of is that Nordstrom management is heavily incentivized to increase the value of the company well beyond today's stock price. In August 2020, an interesting thing happened. I actually found out about this from Mike, otherwise known as Non-GAAP. He has a great, fantastic newsletter that he writes about corporate governance issues, and he called out the fact that the Nordstrom board of directors actually canceled some stock incentives that they had just granted in February 2020 to management. And they did that because those incentives were already underwater, and the board wanted to make sure that the management team was incentivized to increase the value of the company going forward. And so in August, the board of directors canceled the old stock incentives and replaced them with fresh stock options that were struck at the lower stock prices in August. So they were struck just under $15 stock price. And the management team will receive around 1.35 million stock options in total. But those stock options won't be worth any value below $14.79. They only become valuable above that level, and they become more and more valuable at every dollar above $14.79. So for instance, at a $30 stock price, these options would be worth around $20 million in total to the management of Nordstrom. That would be around $4 million for each executive officer. So this is an interesting development because management is incentivized from today's levels to increase the stock price. We also know that the Nordstroms themselves still own a 31% stake in the company. So there is significant incentive here for management to increase value of the company from here. What might I be missing? What are the key risks to the Nordstrom investment thesis? One key risk is that an increase in virus cases over the next 6 to 12 months could force policymakers to shut down shopping centers again. And that would have a potentially negative impact on Nordstrom if store revenues decline significantly again, leading to cash outflows like we saw in Q1 2020. And that might even force the company to raise expensive debt or equity capital, meaning dilution for shareholders or significantly higher interest expense. And there are certain areas like LA and New York City that are a significant portion of Nordstrom's business. I estimate around 10% of Nordstrom's overall revenue, and those areas have been extra cautious about putting in more restrictions when case numbers rise. So we have seen that the desire to shut down entire economies is less than it was in the spring because of the economic damage. But if virus numbers rise enough, then we could see further closures, at least in the short run, and that might have some longer-term financial impacts. When we look at Nordstrom's outstanding debt today, it doesn't concern me too much. Luckily, the debt appears really manageable in terms of interest costs as well as maturities. You can see here the maturities on their outstanding debt, and a lot of their debt doesn't come due until later in the 2020s or even into the 2030s and 2040s. But there is $500 million of debt that comes due a year from now in October 2021, and that will need to either get paid off or refinanced. And I'm hoping that Nordstrom will actually use cash on the balance sheet and cash generated from operations over the next year to pay that down. But if they do have to refinance it and it has to get refinanced at, say, an 8 to 10% interest rate, that could add another $20 to $30 million of incremental annual interest expense, which is obviously not great. It's not a deal killer here, but it wouldn't be the best thing for free cash flow generation. But standing here today, it looks like the interest coverage and debt levels are reasonably well covered by Nordstrom's business as it recovers. When I look at 2021 interest coverage ratios based on metrics like EBITDA minus CapEx divided by interest expense, on my 2021 estimates, I estimate their interest coverage is around 4 times. So that's a pretty healthy level, not suggesting near-term stress. But again, it's something to keep an eye on if more debt has to get added to the balance sheet because of further shutdowns of shopping centers. One of the key longer-term risks with Nordstrom is how consumer buying patterns will shift over time. Will Nordstrom become a melting ice cube, so to speak, as foot traffic continues to decline for malls and department stores like Nordstrom? Can Nordstrom Online even continue to grow if the brick and mortar side of the business keeps shrinking? There is some symbiotic relationship between online and brick and mortar because consumers get familiar with Nordstrom's brand by going into stores and then they cross over onto the online site and vice versa. So there is a real question here about whether or not Nordstrom Online can continue to grow if the brick and mortar stores cannot grow or end up actually shrinking over time. Then there's the question about whether or not consumers will continue these patterns that we've seen during the coronavirus crisis where they're increasingly buying from brands directly online and on e-commerce sites. We even have companies like Instagram that are moving more aggressively into the shopping niche and looking to facilitate customer transactions in their app. We've seen brands like Lululemon, Stitch Fix, Rent the Runway, Revolve, ASOS, Fashion Nova really come up and become big players in the online commerce space. And if they keep stealing share from companies like Nordstrom, then that will be a longer-term issue for the company. I think it's worth calling out Instagram specifically as a threat to Nordstrom because of Instagram's broad reach with billions of users worldwide. Instagram has long been a place for consumers to discover brands, especially brands that advertise on the platform or utilize influencers. But now Instagram is actually making it easier for consumers to transact directly on the Instagram platform with those brands. 2 months ago, Instagram announced that they would be testing adding the Shop tab to the main part of the app, putting the shopping and e-commerce platform front and center on the app. So that is a real threat to Nordstrom. It could also be an opportunity. We do know that Nordstrom uses influencers to push its anniversary sale and for other initiatives, but Nordstrom, if they can figure out a way to use the platform more broadly, could actually benefit from Instagram's e-commerce capabilities. Another threat specifically worth calling out is Stitch Fix. Stitch Fix, like Trunk Club, was traditionally a subscription clothing service, and it's actually grown much faster than Trunk Club. It's kind of what Trunk Club could have been had Nordstrom invested more aggressively in the technological capabilities of Trunk Club. Stitch Fix is run by a great founder CEO, Katrina Lake, and they have now expanded into what they're calling their direct buy initiatives, which allow their customers to buy products off of the subscription cadence, so they can buy products directly off of Stitch Fix's website. And Stitch Fix is a very data-driven company that uses algorithms to match apparel that is really tailored in terms of fit and style to their customers, so they could take potentially a pretty big share of wallet with that really strong relationship with customers. And we have seen the company grow nicely with active clients and revenue. They're now pushing around a $2 billion annualized run rate of revenue, so it has become a pretty big company and could become a much bigger company in the future. They are definitely worth keeping tabs on as a Nordstrom competitor. If you're interested in learning more about Stitch Fix's ambitions in the retail industry, there's a great Invest Like the Best podcast episode with Stitch Fix CEO Katrina Lake, where she talks about trends in the retail industry and where Stitch Fix is headed over the next decade. Now, when it comes to these risks that I've outlined for Nordstrom, there aren't easy rebuttals or answers, but I will say that Nordstrom has successfully navigated and adapted to changing retail market conditions for more than 100 years. The company has been pretty good about responding to changing consumer taste and offering the brands that consumers really want across different styles and looks and trends over time. There are certain retailers who become the hot thing of the moment but are irrelevant after a decade. Nordstrom remains relevant after many decades. And Nordstrom brick-and-mortar stores are actually a pretty useful place for consumers to still go in and touch and try on merchandise, compare lots of different styles or brands. For instance, you can go in and try on 10 different pairs of jeans and figure out what you really like. With online, it can be a little bit slower. You may have to order a bunch of stuff, wait for it to get to you, try it on, send a bunch of stuff back. It's not always the best customer experience. But luckily, Nordstrom does offer both online and offline capabilities. It offers great return policies. It has their loyalty program, which allows consumers to aggregate discounts across spending in many different categories. And the company really does have those value-add services such as style advice and alterations, and especially in its local stores, it's really focusing on making sure the customer experience remains a great one. Of course, there are things that Nordstrom can still do better. There are many different improvements on the online experience that can be improved, and hopefully we will see Nordstrom continue to focus on improving the online experience and making product discovery and product personalization really, really good for consumers through the online channel. At the current stock price, I think the potential rewards for investing in Nordstrom far outweigh the risks. It's not like we need the company to have some massive growth over the next few years or even take massive market share in the retail industry. All the company has to do is continue to execute and see a modest recovery in its business to more normalized levels like they had prior to the COVID crisis, and this should be enough to actually increase the stock price dramatically. I think the stock can be a double or triple within 1 to 2 years. Of course, this isn't financial advice. Always do your own work, make sure you have proper position sizing. But hopefully I gave you some good food for thought. If you have any thoughts or comments, definitely let me know in the comment section, and I'd love to hear from you. Cheers, everyone.